I would like to introduce you to Professor Jos van Bommel of the University of Luxembourg.
Okay. Yeah, the clicker? Yeah, thank you. I think you can hear me because I got a mic over here, right? So, yeah, thank you for the introduction. Oh, we have some more slides here. I do apologize, Julian. I'm going to click quickly through these. Ah, there we go. That's my face there. Let me click through that too. And start with a disclaimer. You may have heard about this saying, those who can do, that's you guys, the value investors, and the other speakers that we'll hear today. And those who can't, they teach, and that would be me, right? So I do teach. I teach at the University of Luxembourg, and I will start my presentation with a little bit of a shameless plug on a new program that we're developing, and that will be given in March. It's an evening course on value investing, a continuing education course on value investing that I'll be teaching together with Thomas Kaspereit of the accounting department and Leon Kirsch, who's from the field, who is here somewhere. If not, he will be later. And this is a course for beginners. We'll start completely from scratch, so probably not for this audience, but perhaps for clients or for staff or anybody who's interested. 6 evenings, and we'll talk about value investing. You may have had a little bit of a flavor on this in the blogs that were published on the website, so columns that I wrote for this website. There were 3, and I wanted to write a 4th one, but I'll just spend the introduction explaining a little bit the 4th one. So in the first column, I explained a little bit about enterprise value. And I introduced the enterprise value, the sum of the market capitalization and the other financial assets, as a market price at which you can buy an entire business. And value investors are interested in businesses. They look at the underlying business. And this enterprise value, or this market price of businesses, fluctuates. Okay? It is thanks to Mr. Market, who can be moody and exuberant. It changes. One day it goes up. The other day it goes down, then it goes up again, it goes down. We know this. It's very volatile. It's more volatile than probably the underlying business. So we want to compare the enterprise value with the intrinsic value and buy the enterprise if the intrinsic value is, of course, higher. Of course, we know that. And the first person to kind of come up with a way to estimate the intrinsic value was the grandfather of value investing, Ben Graham. And he suggested to look at the assets of the company. And in my second block, I looked a little bit deeper, and so he wrote a very big book about it, but I separated it out into operating working capital, your cash and your accounts receivable, your inventory, which is fairly easily to estimate the value of, and the long-term assets, which is much more difficult to estimate the value of. They may be completely misvalued on the books. There may be hidden assets that are not in the books at all. And by discovering these hidden assets, value investors can find very good investments. Okay? That's often called invested capital or net assets. Okay? Now, in the early days, there were companies going around that were trading for far less than the underlying asset value, and Ben Graham and others bought these and made a handsome profit. Nowadays, it's becoming more and more difficult. And most of you, and I saw your presentations a little bit, and last year, will not look at the underlying assets, at the piecewise asset value, but at the cash flows that the company generates. Okay? Those are the arrows there. Okay? And we would discount those cash flows and come up with a discounted cash flow value of a business and compare that with the market price. Okay? Now, value investors, they realize that these cash flows can be separated in 2, in cash flows that are stable and sustainable, the business, the assets in place, and the growth opportunities. Okay? Now, those growth opportunities, they typically take away from the earnings. So they make the earnings less, so you get very low dividend compared to earnings. And then hopefully you get a lot of cash flows in the future. Right? Now, value investors typically, they kind of discard those growth opportunities. They are much more interested in this. Okay? And this makes some sense, because it turns out that for an established company that's out there in the public, it's very difficult to find what we call positive NPV projects. That's because of competition. So in a way, value investors, they believe that the product market is pretty competitive, is very competitive. Another reason why they go for this is because they think that this is very often overestimated, that the market is too overconfident about these growth companies. Okay? So, but this is what value investors do. They look at the sustainable cash flows. So the question then becomes, what is it worth? What is a perpetuity of sustainable cash flows worth? And that I answered a little bit in my third column. And it's actually quite easy, right? Because this is a perpetuity. It comes every year. So you just have to divide it by a discount rate. Okay? So what are the cash flows? The cash flows, I argued, a good one or a very good approximation would be the EBIT, or the operating profit, after tax, because fortunately we have to pay taxes. And a cost of capital, a reasonable cost of capital today, I think 6% is pretty good. 6% return on capital every year after year, you know, call me up if you know one, that's pretty good. So, and of course I chose 6% to make it a round number, but I also think that this is, in the current environment, pretty reasonable. 1 minus the tax rate could be about 60%, and then you come up with 10 times EBIT. So that the company, an enterprise, a business is worth roughly 10 times an EBIT. This goes in very general. You can talk about risk, and we will do in the course, but that at first approximation, EV over EBIT multiple of 10 is pretty good. If a company is even cheaper, that would be even better. Okay? So I saw the presentations. We will talk a lot about multiples, but that is actually a benchmark that is based on discounted cash flow. Okay? And the fourth block that I haven't written yet is going to be about the solidity of the cash flows. Okay? If we kind of assume that these cash flows are sustainable and we're going to discount them at 6%, then we have to make sure that they are solid. Okay? And I'm not talking about whether we can trust the numbers. This could actually be another column, which for sure we'll talk about in the course, because often numbers cannot be 100% trusted. What I talk about in this slide is how likely are they going to reoccur next year and the year after and so on. How well are they defended against outside influences like competition and so on. So, and this requires a story. Okay? And today we're going to listen to a lot of stories. Last year we listened to a lot of stories, very good stories, and in these stories I kind of expect, again, to see allusions to, for instance, how well are the cash flows protected by barriers of entry of competitors, or how strong is the negotiating power vis-a-vis the consumers, the buyers of the products of the company, whether there's a good negotiation power with the suppliers of the company, whether there's a lot of competition within the industry. This is, of course, Porter's 5 forces model, right? A model that I find very useful in answering this question. And I expect to see some direct or indirect reference to this perhaps today in the stories. Perhaps another way of answering this question would be to use Warren Buffett's parable of a moat, a defensive moat, right? So Buffett also suggests that these cash flows have to be protected, right? We want to make sure that they're going to be there forever, because that's how we kind of assume. So we need protection of those cash flows with a moat, and this could be a brand name, a very loyal customer base, technological advantage, top management. Well, I'm curious about the moats that for sure that you will discuss today. Okay? Then the third one that I want to come back to is, again, the invested capital. Okay? Because these cash flows and that invested capital is related. Okay? So if these cash flows that you're going to multiply with a multiplier are 10% of the invested capital, then I'm a little bit less worried about the moat and about the robustness. If the cash flows are 30% of the invested capital, that's great, right? Because that's a return on invested capital of 30%. That's fantastic. But it also attracts competitors. It also attracts substitutes and so on. So if the return on invested capital, which is the cash flows divided by the invested capital, is very high, then you'd better come up with a good story. Okay? And that's what I was going to talk about, and that I still intend to finish this blog and put it on the website in the fourth blog, and of course also in the course. Okay. So with this, my story is finished, and we'll get on with the real stories from the field. And I think that the first speaker is Alex Rubers from Atlantic Capital, presenting one of the biggest funds here. I will serve also a little bit as moderator as last year, right? So I'll ask you to ask questions. And Alex.